Good morning, this is Dave Toth with an RJO MRT Technical Webcast update on the corn, soybean, and soybean meal markets for Thursday, January 19th. Starting off here with an hourly chart of the March corn contract, and as a result of yesterday's continuation of this month's decline, we believe the market has defined the 609 corrective high from Tuesday as the latest corrective high and risk parameter, short-term risk parameter. This market is now required to recover above to confirm the developing potential for a bullish divergence in momentum. But despite the fact that this market has yet to confirm this momentum failure with a proven strength above 609, we are advising traders to neutralize all previously advised bearish exposure and policy and move to a neutral position at this point for the three following reasons. First of all, the fact that the market is developing a bullish divergence potential, but also, secondly, the fact that it's happening at the extreme lower recesses of not just the past month's range between the Jan high at 664 and the key December 15th low at 576, but also dating all the way back to the early October low at 586, with the extreme lower recesses of the past 3.5 months range that creates a poor risk-reward condition from which to maintain a bearish policy, at least not until the market proves broader weakness below that key December low at 576. And thirdly, the fact that we're getting proven strength, at least on an intermediate term scale, in the soybean and soybean meal markets, and we doubt very much that these markets are going to go in opposite directions for any kind of significant move. These issues considered, corn traders are advised to move to a neutral to perhaps even cautiously constructive view of this market, and that would mean covering the remnants of our put diagonal trade, which means covering the short March 590 put at the market, and also covering the resulting short futures position from the 630 level at the market. Needless to say, strength above the 609 corrective high will confirm this move, and by the same token, continued weakness below the December 15th key low at 576 will negate it and resurrect a broader bearish position, or a broader bearish technical condition that could produce significant losses, given that at that point it might be reversing the secular bull trend dating back from the September 09 low at 302. Moving to an hourly soybean contract, you can see the recent pertinence of the 1187 area that we have defined as our short-term risk parameter. It was the initial counter trend low and support at 1193 from the first week of January's setback attempt. That was confirmed as a larger degree correction lower following the Jan 12 crop report. But overnight price action is producing prices currently around the 1195 area. That's going to confirm at least intermediate term strength, and most importantly, we believe define the 1157 low from last Friday as the prospective complete C wave to this month's suspected 3-wave and thus broader bull market corrective sequence ahead of what could be significant gains straight away. In this short to intermediate term regard, that 1157 low becomes, we believe, one of this market's most important technical levels, and certainly the short-term risk parameter of this market would now need to break below to mitigate this move to a neutral to cautiously constructive view. Pertinent to this suggestion that the January correction has ended is the fact that on this relapse in January, the market on a daily log close only basis stalled within 3 cents of the 61.8% retrace of the December-January rally from 1110 up to 1233, and combined with what has been an erosion in bullish sentiment to at least neutral to slightly pessimistic levels, and the least bullish levels seen since the June-July period of last year that accompanied a major base and reversal environment. Excuse me. We believe that, at least from a short to intermediate term perspective, the market has provided enough strength to make it an objective conclusion that the recent lows, 1158 on a daily close only basis from last Friday and 1157 on an intraday basis from last Friday, define an objective low and base from which to base any kind of bullish decisions like covering recently advised bearish exposure and establishing cautious bullish punts for what, if correct, would expose a resumption of the December rally, ultimately to new and potentially significant gains above that January 3rd high at 1245. Again, from a longer-term perspective, and ever since the combination of a confirmed bullish divergence in momentum in mid-December, and given the impulsiveness of that December-January rally, combined with some long-term strength shown here on a monthly log scale perspective that argues that the 2011 setback is the same type of bull market corrective setback that we saw in the second half of 2008, with the market holding former key resistance turned support and a key 61.8% retracement level. We think this market could be in the early stages of a resumption of the secular bull trend. Moving back to a daily log scale chart, and as is typical of most major base reversal environments or processes following that initial and impulsive A or first wave recovery attempt, oftentimes this market has to suffer through a right shoulder or second or B wave correction. And we believe that the past few days recovery attempt is an early indication and an objective indication that the low that has been rejected on this relapse attempt, 1158 on a daily close only basis and 1157 on an intraday basis, provides a sound objective condition from which to base bullish decisions, including, again, covering any recently advised bearish exposure or policy and establishing early cautious bullish punts. In sum, traders are advised to move to a neutral to cautiously bullish policy with weakness below Friday's 1158 low on a daily close only basis required to mitigate this view. And until or unless such such weakness is shown, we don't know that the market is not in the early stages of a C or third wave resumption of the December rally to what ultimately we would expect to produce significant gains above that 1233 high daily close from January 9th. Finally, and similarly, looking at an hourly chart of the March soybean meal contract, you can see the past few days recovery from that intraday low from following the crop report last Thursday. There was the exact 61.8% retrace of the December-January rally from 279.5 to 324.5. But on the heels of a Friday Thursday recovery and a relapse to a 300 spot 60 low that we believe defines the end of a three-wave corrective sequence down from that 324.5 high, given that the market has failed to hold those losses below former support turn resistance in the 311 to 312 area. We think that yesterday's and overnight's strength confirms that 300 spot 60 low from Friday as the end of this second or B wave corrective setback and an objective risk parameter to any kind of bullish decisions heading forward, including covering any recently advised bearish exposure and establishing cautious bullish exposure ahead of what we believe will be a resumption of the December rally to new highs above that January 9th high at 324.5. Moving to a daily log scale chart that gives a better indication of the extent and impulsiveness of the December-January rally that really is a good counter to the 2011 broader decline. A major base and reversal threat we believe remains intact and may even have been reinforced given the extent of the past few days' recovery. That again defines the recent lows as we believe the B or second wave correction within that broader basing and reversal process that, if correct, would expose significant gains or resumption of that December-January rally to potentially significant gains above the 324.5 high. These issues considered, traders are advised to move to a neutral to cautiously bullish policy with weakness below Friday's 300 spot 60 corrective low required to mitigate that enough to warrant moving to a neutral sideline position. Until or unless such weakness below 300 spot 60 is shown, we advise traders not to underestimate the extent to which this market might be able to rally in the period straight away. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.